Fundamentally, business owners don't like paying tax. So the biggest question that we get from most business owners is, how do I minimize my tax? And this is the wrong perspective. Tax is a percentage of a transaction. So how do we minimize that? It shouldn't be tax minimization, it should be tax optimization.
Welcome back. You ready for round two?
Let's go round two.
All right, so you know the drill. Pick one.
All right, let's pick this one. Topic 3 again.
Topic 3. Topic 3 is tax.
Fantastic.
All right. So you and I both live in the country.
We do. In the sticks.
In the sticks. And we live in crocodile country.
We do.
So whenever we mess up and our fences fail or our timing for the weather doesn't work, we have crocodiles eat our animals.
I haven't eaten mine yet.
Yeah, well, you haven't.
Touch wood.
Well, I've lost heaps. Anyway, we call that wildlife tax.
Sure.
Yeah. And wildlife tax is unexpected, horrible, and it can be managed, but isn't always. Yeah. Tell me, when you're hitting a business, 2, 3, 4, 5 million, what are the tax implications in terms of surprises and what can you plan for?
Yeah. So fundamentally, business owners don't like paying tax. Surprise, surprise, right? The biggest question that we get from most business owners is, how do I minimize my tax? And this is the wrong perspective. Because if we boil it down, what is tax? Tax is a percentage of a transaction, right? So how do we minimize that? Well, if the percentage is what it is, we either need to reduce the amount of money that we're earning in that transaction, or we need to break the law. So we need to change the terminology. It shouldn't be tax minimization, it should be tax optimization. Okay? Because there are tax laws that exist that, if you understand the laws, that you can utilize those laws to your advantage. But our goal as business owners should be to pay more tax every single year than we did the prior year. Why? Because it means we're making more money.
The very first business accountant I ever went to, I basically said that to him. They refused to take us on. I'm now grateful. Yes. There's one of those big four down in Melbourne. Yes. And, so we want to make more income. Yes. And we want to optimise. Clarify optimise for me. Optimise. Yes. So we've got to think about the various taxes that we pay. So as a business owner, you pay GST, right? GST, goods and services tax, is a 10% on certain goods or services that you sell, less any goods and services tax that you pay on things that you acquire, right? So there's an offset. Of course, there are certain industries that are GST free, and that creates extra complexity. But the reality is you're an unpaid tax collector for the ATO, so that is what it is. So one of the simple things that we see for a lot of clients is that they quote their pricing inclusive GST. Right. Simple strategy is quote exclusive GST or plus GST. Yeah. Good news is you've now just charged 10% more money. Yeah. Because trying to factor that in, knowing that you've got to give 10% of it away, means that you've only got 90% left for you. What does the law say about inclusive or exclusive? There's no law against it. So, and it makes it easier also if the GST ever changes, and it's been considered on a number of occasions. Whether they will, no one knows. But if you already set yourself up to be plus GST, then it already presupposes hey, we all pay GST, or most of us do. I'm just passing on whatever the government requested. It's also nice and transparent, isn't it? Exactly. Yeah. Makes things simple. So the second thing that's probably the biggest one is your PAYG and your superannuation on employees. Yeah. Now, this is an area that's evolving. We've now got to a point whereby the government have recently implemented what's called Payday Super, which means that on payday, you must remit that money directly to your employees' superannuation accounts. Because back in the day, there was no reporting scheme. Your employee gets a payslip that says, okay, this is how much tax we've held, this is your superannuation that goes into your super fund, and it's only right for the employee to think that money's getting put in. They're not checking that super account all of the time, and we saw that there were businesses who didn't pay super for years. And then closed down. Exactly. So what the government did a number of years ago is they implemented what's called a super stream system, which basically, when the pay was done, there would be a reporting mechanism
and the employers had to remit the money quarterly, and the ATO could see. But it's now to the payday.
Yep.
So what's now going to happen, and it's not too far off, is that on payday, I think the tax or the PAYG is going to be paid as well, meaning that you're going to have to pay for it. Right now you don't, you're still remitting that quarterly with your BAS. So you need to have a mechanism to put that aside because it's not your money. And here's the biggest challenge that I see. When business owners look at their profit and loss statement and they see their wages, that is inclusive of the tax, but they haven't paid it yet. So the key thing is that for all of our clients, we set up a separate bucket for tax, and we put the GST in there, we put the PAYG in there, and we put the super in there.
Because they've already got a system for most businesses have a system for their GST, right?
Correct. But
so it's just a duplication, or?
Surprisingly, most business owners aren't putting the tax aside.
Even the GST? Even
the GST. They just have everything go into a single account, and if it's there, they pay it, and if not, they go on a payment plan. And the interesting thing as of this financial year is the ATO, because they're clamping down because there's so much unpaid tax, when you're on a payment plan, the general interest charge, the penalty that you pay to the ATO is no longer tax deductible. So they might charge you 8%, but you've got to pay tax on that. So that's equivalent to a 12% interest rate. So it's just, we see this all of the time, even in multi-seven-figure businesses. And you need to have a system for setting aside that tax. So for our clients, when they implement our system, most of our clients end up over-saving for tax, which then means that they have extra funds that they can then put aside for their profit. It's a forced savings. So they can always pay their tax on time and in full. So the next tax is our corporate tax. So assuming that you're running a business, which most of our clients run a company, the corporate tax rate is 25%. And you're going to pay that on anything that's left over. So revenue minus all of your expenses is profit, and you're going to pay 25% tax on that. And then you're going to pay top-up tax if you distribute it out to an individual. So we get a franking credit for that 25%. And as a general rule of thumb, our goal is that for our individual clients, we want them to earn up to $200,000 each, because that gets them to an average 30% tax rate. What many people do is they end up pulling out whatever they need, in many cases exceeds 200,000, and then their accountant at the end of the financial year goes, hey, you've got this tax bill you've got to pay, and they go, I don't want to pay that. And then they find themselves in this situation of having what's called a Division 7A loan, or a related party loan, where they're basically trying to say that they've borrowed money from their business, but they now need to pay that back to the business. They need to pay interest, and that now creates a compounding tax issue. So the big thing is, for most business owners, most of their tax issues are not glaringly obvious, right? They have a lack of a system, and they have a lack of a strategy, which means that they end up paying surprise tax bills, or they end up making financial decisions like Division 7A loans without understanding the tax consequences. And that's why their tax is not optimized.
Okay. And what about the strategy that I have seen in a lot of businesses, which is, I need all this money to keep running my business and I'll just build up a debt?
Yeah, it's a very dangerous game to play. So back in the day, businesses used to use the ATO as essentially an overdraft facility, and the ATO is really lenient. Like, unlike the US.
Used to be, or is?
Well, they're starting to get tougher. And look, we're still very fortunate that the Australian Tax Office is not like the Revenue Office in the States, where they'll just send you straight to jail. There's very few people that go to jail for tax and for not paying their taxes, but they do have the power to do that. And there's certainly more people that are getting that kind of penalty. However, they're still not as strict. So business owners have taken it for granted, right? And what many business owners have done is that they've just said, I'll put that on a payment plan so that I've got extra cash that I can reinvest back into my business, and then I'll deal with that later once I get to a certain level of scale.
That's also expensive cash, isn't it?
It is. It is expensive cash. But in saying that, like, for example, in the good old days, we would have a client come to us with a tax debt. So I had a client who come to me who was a very prominent real estate agent in the eastern suburbs of Sydney, making millions of dollars a year. Hadn't paid tax for years, didn't even submit his tax returns. And he's like, I'm scared I'm going to get a knock on the door. I need to get it sorted. So we did his draft tax returns. He owed $1 million to the ATO. And so we said, okay, here's going to be the strategy. We're going to submit the tax returns, we're going to immediately call the ATO and we're going to tell them, we're going to show them your financial position, that you don't have the money, you've basically spent it. And we're going to offer them 30 cents on the dollar, and we're going to get them to waive all general interest charges. And the ATO took it. So like prior to COVID, we had these really lucrative negotiations that we could do with the ATO. Because the interesting thing is when we look at the ATO looks at any debt that's outstanding for more than 12 months. For every month that it's outstanding, the percentage in terms of certainty of recoverability just drastically declines. Yeah. So they're like, well, I'd prefer to have 30 cents on the dollar than nothing. So
is it like that now?
No, it's not like that now. So since COVID, basically the directive was from the powers that be is that their number one revenue mechanism is the ATO, and there's so much money outstanding that the ATO is now enforcing what's called directors' penalty notices. So one of the great things about running a company is that it's a proprietary limited company, meaning that as a director, you have limited liability.
Yep.
So for as long as you don't do fraud, you can wind up the business and walk away from the liabilities scot-free.
Yep.
A director's penalty notice makes you personally liable as a director for the company's liabilities.
So how can they do that?
They have the power to do it. Because what their positioning is like, you know this is a debt as a director, you have decided not to act upon it, and therefore we're going to enforce it upon you. The other power that they have is they have the power to issue wind-up notices, which essentially is like, you are not fit and proper to run a business. Doesn't matter the size of the business. Like, we've had clients come to us with 8-figure businesses, and they've received wind-up orders from the ATO.
Because they have huge debts to the ATO.
They defaulted on the debts and just continued to not pay. So basically, that just now wipes your ability to run the business. It's gone. So the ATO is getting very, very fierce. So it's just important to be proactive.
So you can plan your tax like another expense, yeah?
You should.
Yeah.
But it comes down to, what does planning mean? Right? Like most business owners' planning is meeting with their accountant once a year and doing their tax returns and financial statements.
Really?
Yeah. And here's how the story goes. Like let's say it's July, and they meet up with their accountant, and their accountant goes, hey, here's your financial statements and tax returns. Here's your tax liability. Oh, I don't like that. Okay, well, what can we do about it? Oh, well, we can do that Division 7A thing that we spoke about, because you've taken all this money out of the business and you've spent it, so you can't pay it back. Yeah, cool. Am I going to have less tax to pay? Yes. All right, cool. So the accountant is essentially just kicking the tax tin down the road.
Yeah.
And it just continues to compound.
Yeah.
And inevitably what happens is they end up calling us saying, hey, I'm in $1 million of tax debt. Can you help me? And there are certain people that we can help, but there comes a point of no return.
Yeah.
Right? Because the biggest issue with having an accrued tax debt is that not only are you having to save to pay the back tax, but you've also got to save for the tax that you're accruing as you go. So it's like a double whammy.
Yeah.
And there are some businesses that we can get out of the hole, and there's many that we can't. And look, the saving grace is for businesses who do have less than $1 million in total liability. They can do what's called a small business restructure, an SBR. So after COVID, because there were so many businesses that were failing, the government simplified the rules around restructure. So you don't need to go through a full insolvency. So it's like, if you've got less than $1 million in debt, we can go through a small business restructure. We basically clear most of those debts, or in some cases all of them.
In the same way that a bankruptcy used to?
Yes.
Or, yeah, okay.
But it has no personal impact. And then you can set up a new company and start again from fresh. But you can only do it once. So the key is doing it when you've got less than $1 million in debt.
How many business owners know about it?
Not enough. Yeah. And interestingly, like, we don't specialise in this space. We usually refer those types of clients out. But yeah, a lot of similarly, like, businesses leave it too late. Yeah. And the key point here is, like, if you're in this level of tax debt, you're not building wealth.
No.
The key point is, like, if you're struggling to pay,
unless you're stealing.
Exactly. Exactly. So if you're having struggles with paying your taxes, or it's impacting your cash flow, we need to implement a better system.
Yeah.
And we need to make sure that you can be profitable and pay all of your taxes on time and in full.
So what's under this? The very first thing you said was most business owners don't want to pay tax. What's under that? Where does that come from?
It comes from a lot of things. I think, and I resonate with this. Like, I think people are disgruntled with how the government is spending the money. And therefore they're like, well, I don't want to fund this regime that I fundamentally disagree with. And look, I get that. I do think that the government has been irresponsible with the spending, but I also think that we live in such an amazing country. We all have a duty to pay our fair share in tax, but only our fair share, no bonuses.
Yeah, yeah.
And I also think that there is a lot of accountants to blame for this.
Yeah.
The accountants, like when you're a hammer, everything looks like a nail.
Yeah.
And most accountants want to justify their worth by how much tax they save to their clients, and the best way to pay no tax is to not make any money. So the amount of accountants that I've heard telling our clients, oh, pay yourself 30 grand a year. Oh, go and buy more vehicles and rack up all of these deductions so you can reduce your tax.
Yeah, yeah.
It's just dumb.
Yeah.
Like, if you don't need to spend the money,
don't spend the money.
Don't spend it.
Yeah.
So I think there's just this narrative that has become the status quo for business owners around how they should treat their tax. And I think it's short, and I guess the other part around this as well, particularly when you're building a multi-seven-figure business, like you might be paying $1 million a year or more in tax. And that stings, because particularly when you think of like, oh, that's coming out of my pocket, that's coming out of my children's mouths. It's easy to allow that narrative to dictate your relationship with tax. But to pay $1 million in tax, you've probably made $2 million in net profit. And assuming that you've got a good system to maintain that $2 million and then go and invest it, then you can make back that $1 million in tax that you paid very, very quickly through smart investment decisions.
Yeah.
So a lot of the work we do with our clients to help them make this shift is just, okay, we're going to actually show you where you're going to pay more tax than you've ever paid. And they go, that's ridiculous. Okay, but hear me out. Let me show you that we're going to pay that tax so then you can increase your personal earnings. That's going to allow us to borrow more money to go buy more properties. And then if we buy these properties based on a conservative growth rate, this is how long it's going to take you to make back the tax money. And then everything else is cream on top.
Yeah.
And they go, okay, I get it.
Yeah.
I get it. So it's putting it into context. Tax is a consequence of making money.
Yeah.
So the goal is, well, as a result of that consequence, what have we got to do with what's left to justify that consequence?
Yeah. Yeah.
And then it becomes a game.
Yeah. All right. Sounds good. So when should business owners get educated on tax?
They should know from the very beginning, right? And this is often the biggest complaint, is that most business owners come to us and say, my accountant never taught me this. Like, they never told me I was supposed to do this.
But they don't work on an education basis. They
don't, no. And accountants are typically weird people. So they're not synonymous with their social skills, right? So this is the big thing, right?
Yeah.
You need to invest in that education and just understand the fundamentals. And I think the challenge is most people, business owners of all sizes, they don't think they're finance people. So they abdicate responsibility. They hire a bookkeeper, they hire their accountant, they hire a financial advisor, and they usually go, oh, you just take care of it for me.
But don't most business owners start somewhere along the line with, I want to do this to make money?
Sure.
So then why would they consider themselves not finance people?
It's peculiar, but it's just how things are, right? They want to make money, but they don't want to deal with the nitty-gritty of the money, right? And that's the reason why they're not making the kind of money that they should.
How can we get that? How does that change?
Well, we simplify this, right? There's a compliance function that you shouldn't do, right? Business owners shouldn't do their own bookkeeping. They shouldn't do their own taxes. They shouldn't do their own tax planning. All of these, they shouldn't do their BAS. They should hire experts that do these things. But what should business owners do? Business owners should manage their cash flow. Because the interesting thing is there is often a fundamental disconnect between accounting and cash. One of the biggest complaints that we hear from our clients is they go and sit down with their accountant and look at their financial statements and tax returns, and the accountant says, oh, hey, congratulations, you've made $1 million in profit. And they go, where the fuck is it?
Yeah.
And it's because they don't understand how money flows from the profit and loss to the balance sheet to cash flow. Whereas a bank account balance never lies. There's either money in a bank account or there's not.
Yes.
So what we implement for our clients is a series of bank accounts that we call buckets.
Yeah.
So we have what we call the hub account, which is what receives all of the income for the business.
Yep.
We then set aside money for GST. and then we have an account for cost of sales.
Yep.
Right. So top line revenue minus GST minus cost of sales leaves us with our gross profit, or we call it real revenue. Then we have an OPEX account, or operating expenses, that pays for salaried employees, rent, utilities, fixed expenses.
Overheads, yep.
Then we have an owner's pay account, pays the number one employee, the owner, and we segment that. Otherwise, it's just going to get consumed by everything else. We have a tax account. That's where the GST goes. That's where the PAYG goes. That's where the super goes. That's where the corporate tax goes. And then we have a profit account. That's where the profit goes, and that's how the business owner gets 2 paychecks. Yep. Owner's pay and then profit. So what we do for each business is we work out what percentage of every dollar that comes into the hub account goes into all of the buckets. And then usually once a week, ideally we get to a point once a fortnight, where all of the monies come into the hub, and then they sweep all of the money to the other buckets. So then the hub has 0 in it, and all of the other buckets are filled. And then they only spend from those specific buckets for the specific intended purpose.
What sort of percentage do they put in that tax bucket?
So usually about 20%. Yeah. And that's 20% of real revenue. So once they've swept for the GST and swept for the cost of sales, it's 20% of the real revenue.
Another 20%. So in truth, it's about 30%.
Yeah, if you've grossed it up, correct. And then it really depends on the business, but usually we want to have at least 20% in profit. So if we've got our real revenue and we've put 20% in profit and we've got 20% into tax, we usually have about 10% into owner's pay. So that leaves us the residual for operating expenses. And we actually do it in that order because what ultimately happens for most business owners is that they're making revenue, they're spending on all their expenses, and then profit is whatever is left.
Yeah.
Right? But when we put profit first, tax second, owners pay third, and OPEX last, it forces them to be resourceful.
But how can you do that?
Exactly.
Can you do that?
Yeah, because there's really one of 3 outcomes each week. And we call this the come to Jesus moment, right? Is that usually at the end of each week, outcome number 1 is there's enough money in the OPEX. Beautiful. That's what we're working towards. But when we start this, it's very rarely.
And this is a weekly thing.
Weekly thing, every week. Outcome number 2 is there's not enough money. OPEX is insufficient. So then you've got to borrow from the other buckets. But you were doing that anyway, just without knowing.
Yes.
But the important point being is that you've had a conscious point of going, I don't have enough money in the OPEX. I need to steal from the other buckets to fill it up. So you now have transparency and clarity. Or the third outcome, which is the ideal one, is there's not enough money, and then you go and make more revenue.
Yes.
Okay, I need to chase up my accounts receivable. I need to go and get more sales. Because that's the issue in the first place.
That is the real issue. Yeah.
Correct.
Yeah.
But what it does is it forces you to shine light on it, so the bank account balance influences your behaviour in your business.
So I get that, and I think that's brilliant. I don't quite get the borrow from the other accounts.
Yeah.
So is that a on paper thing? So you put tax should have been this much, or you actually physically...
You physically transfer it, because obviously you've got to pay the OPEX bill. Let's say you got to do payroll and there's not enough money there.
Yeah.
So now you've got to borrow from the tax bucket or the profit bucket to top it up, right?
And then it's noted $10,000 borrowed from the tax bucket.
Exactly.
But
it's a Band-Aid solution, right?
Yeah,
and inevitably what this comes down to, and we see this with our clients, and when we implement this, it usually takes them about 6 to 8 weeks to get it dialed in.
Yeah.
The first instance, it's like, oh shit, like this, I can see why this is wrong.
Yeah.
And then the deeper issue is like, well, it's a pricing issue, or it's a volume issue, like they just don't have enough clients, or it's a cash collection issue. And it's usually one of those 3 things. Or they've got too many expenses,
But
right?
this makes them ask the right questions.
Correct. Because prior to that, they were just borrowing from the other buckets without even knowing. They were unconsciously incompetent and then wondering where their money went.
So it was, which one was first?
So profit first.
And what percentage did you put in there?
We usually, the target's 20. But what we do is we do a rollout plan, usually over a period of 4 to 6 quarters, depending on the client.
And it rises.
And yeah, so what we do is we look at what it is now. So we crunch their numbers for the last 3 months, and let's say their profit's 2%.
Yeah.
So we'll extend it to 4%. So like, okay, let's do a little tweak and push it.
Push it.
And then we'll make the adjustments to the other levers. And then we go, cool, we do weekly sweeps, and we actually get them to track their emotions when they do the sweeps. And when we get 3 consecutive weeks of green, then we increase the percentage again.
So it goes profit, then
Tax,
and that's which tax?
20% typically. So that's going to be your PAYG, your super, and your corporate tax.
And that's 20%, okay.
Yep.
And then your
Owner's
GST?
pay?
Oh, okay. Owner? Yeah.
And generally that's 10%.
And then
And then whatever's left is OPEX.
Where's GST?
GST goes into the tax account. We take that first.
So the tax account doesn't get 30%, it gets 20%.
Yeah, so if you think about it this way, money comes into the hub.
Yep.
We take 10% off and put that into the tax account. So we're left with the 90%. Then we take money off for cost of sales, whatever that might be, and that gives us real revenue. And then we then split of what's left, 20% into profit, 20% into tax, 10% into owner's pay, and the rest into OPEX. So there's multiple different sweeps, so we can factor in GST first, cost of sales, then profit, then tax, then owner's pay, then OPEX. We've got a spreadsheet and a tool that calculates all of this.
I just wanted to get a feeling for it.
Yeah.
And wow. To me, that activity solves that very first problem that you brought up, which is, I don't even know when you brought it up, which was that people don't know their numbers.
Correct.
Because if you're sitting there going, I can't pay my staff who are now going to revolt like, the peasants in France, you've got a real problem.
For sure.
Whereas if you paid it, but you think, I didn't pay the tax this week, who cares?
Correct.
Almost.
Exactly.
Yeah.
And this is the interesting observation, or one of my mental models. Numbers in isolation mean nothing without context.
Yes.
And where do we get context? Well, context is about having a target, having a baseline or a benchmark, or to a previous period, whether it be the prior month or the prior year. But we need context to understand, is it good or bad?
Yeah.
And that's the issue most business owners lack, is they don't have any context.
Which is amazing. That's just blown my mind, that one. That's just amazing.
And the interesting thing we find across our client base, because we've implemented this with thousands of clients, once they implement this and dial it in, on average, they increase their profits by about 20 to 30%.
Yeah, I can see that happening. I also like the way you've got profit up the top.
Yes.
Because that goes with the pay yourself first.
100%.
And I like that a lot. All right. Okay. So, tax. There is a system that will enable you to be aware of your tax liability.
Yes.
And keep it front of mind, even though you'd rather forget it.
Mm-hmm.
And you've talked about some ways to deal with it if you're in the shit with it, which is good, because I think there are probably a very high percentage of people who are behind in their tax. Mm-hmm. Well, according to the tax office, there's almost all of us.
There's lots.
What about these strategies that the accountants give you, which is buy a new fridge, go and get some cars, pay charities? Tell me about those. They smell to me, but I don't really know why.
Yes. So what we're going to realise is that tax minimisation strategies, which is what these are, get you back cents on the dollar.
Mm.
So the simple way to rationalise this is, would you prefer to spend $1, the government gives you back 30 cents, but you're still out of pocket 70 cents? Or would you prefer to make $1, the government takes 30 cents, and you are still 70 cents better off?
Yeah.
Which one do you want?
Yeah. And people choose the right one.
Exactly. So when we put it into that context, because this is the issue with tax minimisation, it's forcing you to spend $1 to save 30 cents. It doesn't make any sense unless you needed to buy it in the first place. So the conversation we have with our clients around tax planning at the end of the financial year is, okay, are there certain things that you need to buy that we can do at this financial year and claim it to offset the tax?
Yeah.
Cool. So if you don't need new cars, if you don't need new equipment, if you don't need these things, then don't spend the money.
No.
Right? But there are other things that we can do which are actually beneficial. So one of the things that many business owners take for granted is putting money into their superannuation.
Yeah.
So as it stands right now, each individual has the ability to put $30,000 a year into their super fund pre-tax. So you can claim a full tax deduction on that contribution.
Wow.
Better yet, there is also what's called bring forward contribution. So if your super balance is below 500,000 and you have unused concessional caps for the previous 5 years, then you can use all of those in one go.
Wow.
So then you can get a full
so you
tax
could put
deduction.
1.5.
Or you could potentially put, if let's say the cap has been 30 grand for the last 5 years, and let's say you've only put in,
grand.
Wow. But usually most business owners are putting in 12% on their salary, right? So there's usually not all of the cap that's available, but in theory you could, right? So you can use whatever's left. So there's great tax planning opportunities, which isn't just spending on crap.
Yeah.
That's putting money into another tax structure that is still your money, right? So there's things like this that we can do. But what I often see, the biggest issue with this tax planning thing that accountants aren't having the conversation with because they're not qualified or licensed to have the conversation, is that our clients inevitably want to buy property, right? And to buy property, they need to take on debt. And the biggest complaint is that they go to the banks and the banks say, sorry, computer says no. You can't borrow the money because you're not earning enough on paper.
Because the business is earning the money, not the...
Correct.
Yeah.
So the big thing we talk to our clients about is what are you trying to do in wealth building in the next 12 months? So if you want to buy 2 investment properties to a value of 1.5 million, then as a general rule, you've got to earn an extra 200 grand a year to service that debt.
So you have to pay yourself.
Pay more tax, right? So because there's going to be one of 3 scenarios there as well. Either A, you want to buy property next year and your taxable income is sufficient to service the debt. Beautiful. Outcome number 2 is that you don't currently pay yourself enough, so you need to increase that and the business has the capacity to do it through distributions. Beautiful. So we can solve that issue. Or outcome number 3, you're not earning enough and the business doesn't have the profit, but we can now set an income target in the next 12 months to say, cool, if you can get your profit to here, then you'll be able to go buy that next property or 2. Yeah. So at least then our clients are like a dog with a bone. They're like, cool, I now know my number. Yeah. Well, I'm going to go here.
They've got something to attach that work to.
Correct. Yeah. Exactly.
All right. And what about depreciation schedules? Are these things that are useful in helping businesses manage their tax? And where can people learn about that?
Yes. So look, depreciation is a natural part of tax. And I guess the thing to be mindful of is depreciation is a non-cash expense, right? We buy an asset and the government has determined the rate in which that is losing its value. And therefore they allow us to claim that value proportionately each year. But this is really important when it comes to property. Because there are also a lot of business owners who get caught up in buying brand new off-the-plan property because of the sold tax benefits. Right. So there's a lot of spruikers out there that say, hey, buy this off-the-plan property. It's going to be cash flow positive after tax. And the issue with depreciation on a property is the depreciation that you're claiming in your tax actually reduces the capital base. And what that means is that when you ever sell it, you end up paying more capital gains tax. Yeah. And they don't tell you this. No. Right? They say, oh yeah, you're getting this great cash benefit, but if you ever sell it, then you're going to end up paying more tax. So it's something that, once again, we don't make financial decisions purely on the tax benefits.
No. Okay. What else do business owners not think about ahead of time when it comes to ways to optimise their tax in a way that helps their business?
There's a huge one. It's called the Small Business CGT Concessions.
Okay.
So this is the best tax rule that we have in Australia.
CGT?
Yes, so the capital gains tax, small business capital gains tax concessions. So as a small business owner, and the government defines a small business for these concessions in one of 2 ways. Either your business is worth less than $2 million, okay? Or you have net assets of less than $6 million. Yep. So that includes the value of the business and your personal assets. So if you have either of those scenarios, you can qualify for the small business tax concessions, which there are 4 rules. The first one is what's called the active asset, which most business owners will qualify for. So what it means is that if you sell your business, you'll get a 50% reduction in the capital gain, which can be combined with the existing CGT discount for holding an asset for more than 12 months, which then means that you get a 75% total reduction on capital gains.
Okay, right? So you sell your business for 10 million and you only pay 30%.
25% tax. And then
tax on that.
That's usually on your marginal tax rate, so your actual effective tax rate might be less than 20%, right? Which is really good. Next one is the 15-year rule. So if you've owned the business for more than 15 years, completely tax-free. Next rule is the retirement exemption. So if you're selling the business and you're over the age of 55, you have the opportunity to put the proceeds of the sale into superannuation and you don't pay any tax. And then the last rule, and there's a lifetime cap of $500,000 per person. And then the last rule is what's called the rollover. So if you sell the business and you use the proceeds to buy another business within 2 years, you can defer the tax indefinitely.
That's a bit like homeowners and their initial property.
Yeah, exactly.
Yeah, okay.
So the great thing about this is, like, for a lot of our clients, if we get this strategy right, they can pay no tax.
Yeah.
So we had a client who come to us, bought this business for about $2 million. Over the course of a few years, we strategically scaled it up to $5 million, sold the business. She didn't hold it for 15 years, so she didn't achieve that, but she got the active asset because she was running the business, so 50% reduction. We then put $500,000 into her super, $500,000 into her husband's super, and then we did a rollover with the residual to go and buy another business. Zero tax.
Wow.
So basically, she took a business and created $3 million of asset value and paid not a dollar of tax on it.
Yeah. And tucked away $1 million in
100%.
super and bought a new business.
Exactly.
To do it again.
Exactly. And the great thing is that she could use the rules again too.
Yeah.
So there is a tremendous opportunity that we've got to realise that every person is going to end their business one day, whether they like it or not, right? It's either that you sell it voluntarily or you sell it involuntarily, or it gets wound up, right?
Or you die.
Yeah, exactly. So that's the involuntary part. So you may as well plan for it.
Yeah.
Because there's value there.
And actually, a lot of people start a business or buy a business with the intention of, this is how I'm going to offload it.
But they don't have a strategy. And they don't know about these tax rules.
No.
So once again, once they know it, it now creates this lens that they view their business through that they can be optimising in pursuit of.
Yes.
And it just changes the way that they run their business.
So if they're at year 14 and a half, they wait 6 months.
Correct.
Yeah.
Exactly.
Or if they're 54.
100%. You wait till you're 55.
Yeah.
So there's these things that just make it so much better for you as a result. And look, and the reason why the government has these rules is because business owners sacrifice their income. They don't put money into super typically, or at least they don't put enough into super. So you deserve to take advantage of these rules, right? And there's so many businesses that have come to us that didn't think that they could sell, and we've helped them set up and structure it in a way that they could. And this is a way to accelerate your path to creating financial freedom.
Wow. That is a really good one. All right. GST. So when GST came in, what year was that?
I can't remember.
Ages.
2000, something like that.
I was coaching business at the time. My clients were okay, but I saw a lot of businesses go out of business. In fact, there are a lot of clients I didn't take because looking at them, they weren't going to be able to cope with the unpaid tax collection and the paperwork, which for many small business owners at the time, I'm talking micro businesses, they couldn't cope with it. What is the least effort way of dealing with GST now?
The philosophy needs to be of this, and it goes for anything. Like this goes for anything that is enforced in the external environment on you, which is market conditions, inflation, GST, like
Taxes.
Anything, right? These are all taxes on the people who fail or refuse to take action and adjust accordingly.
Yeah.
Like the job of you as a business owner is to understand and respond to these external forces, right? And if you fail to, your business will fail.
Yes.
So it's you either find a way or you find an excuse. And like now, because GST's been around for so long, it's just become second nature. So it's just little things like quoting your prices plus GST.
Yeah.
The big thing I see is like, if tax is an issue for you, then you have an issue in your financial model.
Yes.
So I always question, when was the last time you put your prices up? And interestingly, like from all the business owners I speak to, they either can't remember, or it's been years, or it wasn't even in line with inflation. So it means, okay, so you're running your business to make less money every year. Why?
Yeah.
And interestingly, we found like across all of our clients, when we implement price increases, their biggest fear is obviously losing people. And
losing customers.
Losing customers, right? And in the vast majority of cases, they lose no one. And in some interesting cases, their conversion rates go up.
Yeah, because it's more valuable.
Because there is a price anchor associated with perceived value, right? Things that are more expensive are perceived to be more valuable, which means that they're more desirable, and therefore that influences conversion.
Yeah.
And like, it's interesting, I heard another creator say this recently, like the middle is where businesses go to die. You either need to be really expensive or you need to be really cheap.
Yeah.
Don't be in the middle.
Well, and also if you're really cheap, you have to do a lot.
Correct.
Yeah. So,
It's an efficiency play. You got to, it's economies of scale.
Yeah.
And it's just, I would always prefer, and we advocate and help all of our clients, how do you get to the premium end of the market where you can be the most expensive? Because there's always going to be a market for the most expensive.
Yeah. In anything.
100%.
Because there are people who will only buy that.
Correct.
As well as people who will only buy the cheap one.
Exactly.
Yeah. Wow. Okay. So businesses that have problems and encounter problems because they're trying to avoid or minimise extremely their tax.
Yes.
What's the mental framework behind that, and how do they change?
The big one is that Division 7A tax. Like that is that is the biggest issue that plagues successful business owners that I see. And how it arises is that business owners think the company's money is their money, and it's not. So what inevitably happens is that they pull money out of the business, they haven't set aside the money for tax, they get to the end of the financial year, and the accountant gives them 3 options. They go, hey, you've taken this money out as a director's loan, you could put it back. You've spent it. Okay. Well, we can distribute it as a dividend, and you're going to have to pay some top-up tax. They're like, fuck that. What's what's option 3?
Yeah.
Well, there's this Division 7A thing. And before the accountant even finishes speaking, they go, yeah, let's go with that.
Because it seems to have no cost.
It seems to have no cost. However, that loan that they're taking, let's call it 100 grand. The next year, they need to pay it back to the principal and interest over 7 years. The interest rate is 8%. And then for that principal amount that's paid every single year, that needs to be paid out as a dividend in the year the principal is repaid, which creates...
So they also have to then pay out...
Correct. So you're now paying tax twice. Now, if you fail any of these steps, the consequence is that the amount that you've taken out is treated as what's called an unfranked dividend, which now means that you must pay all of the personal tax yourself, which in many cases is at 47%.
Wow.
So there's huge consequences if you get the compliance wrong, and you're kicking the tax tin down the road. Like, you're telling yourself, I haven't prepared for it now, so I'm going to be more prepared for it next year. And it's a compounding issue because it's usually 100 grand this year, 200 grand next year, 300 grand the year after. Like, we have people who've come to us with multi-million-dollar Division 7A loan balances and are saying, I've got this huge tax consequence. What's going on? And we talk them through it and they just don't realize it. So the Division 7A is not all bad. Like, there is really only one situation where it makes sense. That your business has profit, you're going to take that profit out on a Division 7A loan and you're going to use, because you want to have more money to go and buy a property asset. Right? Like, we have a client that come to us and he wanted to buy a big commercial property. It's going to be about a $5 or $6 million acquisition. And he's like, look, if I pay the top-up tax, which is an extra maybe 15 or 17% tax, it would be the difference between getting the deal over the line or not.
Right.
So we're like, okay, well, let's do a Division 7A. We'll take the money out of the company. We'll go buy this commercial property. That commercial property is going to be cash flow positive. So the cash flow that's going to come from that is going to help us pay back the loan.
Cool. But that's doing it from the thinking forward end.
Correct.
Not trying to solve it
100%.
at the other end.
Because where most people find this issue is that they're just pulling money out for lifestyle.
Yeah.
And they're spending all of the money and they just don't have the money there to pay for the tax. So in that situation, you're better off just declaring the dividends.
So do accountants know what they're creating for their clients when they do this?
If I put it bluntly, they're gutless. They do not have the courage to have hard conversations with their clients out of the fear of conflict, of the fear of being the bad guy.
They do position themselves as the rubber between you and the ATO, whereas they don't have much flexibility at all, really.
And look, this is a little bit of a conspiracy that people are going to call me out for. But the more complexity that is created, the more fees they can charge.
Yes.
Because they've got to do Division 7A loan balances and arrangements every single year. The bigger that is and more complicated, the more they can charge you. The more complex the tax structures are, the more they're going to charge you to set it up and do all of the compliance. Like, there is a vested interest in you suffering. because if you need someone to negotiate the payment plan with the ATO, they're going to charge you hourly for sitting on hold for 3 hours.
Yeah.
And they're probably smiling about it.
Yeah.
So this is the biggest issue, is that there are a lot of accountants out there that take advantage of their clients being naive and not knowing any better. And they
So
should
what's
be
this form
ashamed.
called again? S7, what about?
Division 7A loans.
Division 7A loan. So if you hear the accountant say, get a Division 7A loan,
Yes.
call Jackson.
Yeah. And the good thing is I've got a playbook on this, because I had so many people reaching out to me on social media asking about it, because they just didn't understand it. So I created a playbook with a series of case studies that actually show people all of the calculations and just puts it into context. Once again, the numbers in isolation don't mean anything without context. So I've mapped it all out. And the people who get it, they go, wow, this finally makes sense to me, and I'm never going to do this bloody thing.
No, unless, as you say, it's a strategy up front that makes financial sense. And yeah, okay. Yeah, sounds good. All right. So is tax the big boogeyman that everyone thinks it is?
No. We just pay our fair share. Like our strategy we implement for our clients, and the same for myself. I will pay a maximum of 30% tax, right? Not $1 more. So that means I've got 70% of all of the money that I earn that's mine to keep and to put to work for me. And we do that through setting up the right tax structures and the appropriate tax planning. And I'm happy with that, because I'm still getting the lion's share of all the money that I produce. I'm contributing to society, this beautiful country that we live in, and I'm paying more tax every single year. It's just the percentage is always 30%.
Okay.
So, but if my income doubles next year, I'm going to pay double the amount of tax.
Yeah, but still 30%.
100%. So that's always the tax planning strategy and the lens that we look at it through for our clients. And once clients see the strategy played out, then they believe in the system. And the big piece of advice that I've got for everyone is change the relationship you have with paying your tax.
Yes.
Don't go, oh, fuck this, I'm paying my tax. Like, pay your tax bill with a smile on your face.
Yeah.
Right? Because it's a privilege.
Well, it is. I mean, the fact that you made enough money to be able to contribute back to your society is the absolute opposite of, where people don't want to go.
Correct.
So,
yeah.
Good.
Exactly.
All right. Have I dug through the different tributaries of tax, or have we got an area that I've missed?
I think we've pretty much nailed it.
Yeah?
Yeah.
All right. Then we will do our game.
Let's do it.
Okay.
I'm going to pick this one this time.
Aha! Okay. Your question, which has nothing to do with any of this stuff, is what is the scariest thing you've ever done in business? And what was the best thing you've ever done in business?
I think the scariest and the best thing are actually one and the same.
Yeah.
So about, probably be nearly 2 years ago now, I bought out a bunch of my business partners. So when I started the business originally with my original business partner, Sam, we run the business together for about 7 years, and we just wanted different things, right? And we wanted to go in different directions.
Was he an accountant?
No, he was a mortgage broker. And Sam is a phenomenal operator. He's still a very good friend of mine, but he just didn't want the burden of responsibility of all of the team and complexity, right? Yeah. And we built this big beast, and what I wanted and what he wanted were fundamentally different things. We had another partner who funded us when we raised capital in the beginning, and there was another partner that we wanted to buy out of another one of our businesses. So I basically said, look, I'll buy all of you guys out. So I had to take on a pretty significant amount of debt to do that, and I cashed them all out. So it was scary because it was taking on this tremendous burden of responsibility, like $30,000 a month in minimum repayments on this debt.
Yep.
But it was the best thing because, similar to my story of when I started in business, being forced out onto my own, it was the next level of skin in the game that has now allowed us to our business is growing 30% quarter on quarter.
Wow.
So
quarter on quarter.
Yeah. So we've accelerated our growth far beyond what I could have ever imagined. And if I look back, would I have done that if everything stayed the same? Probably not.
So I'm not supposed to ask a second question because I got my question. But if you had not, when you bought out and it was yours to do with as you wish, did you act differently to how you acted in terms of trying things and your values and where you wanted to go and your vision for it? Did you act differently to how you had before?
Yeah, I just put the foot down on the accelerator. And look, I love Sam like a brother, but he couldn't work at the pace that I could work.
Yeah.
And I think I matched him at his level of what he was able to do. And when it was just mine, and I've still got other business partners in parts of the business, but I own the mothership, the holding company, and it's now my sole responsibility to drive that forwards. It just fundamentally changed how I showed up. And coupled with the debt and all of those things, it just became rocket fuel.
Yeah.
And it's interesting. You don't know your limitations until you're forced to push past those limitations. And it's only in hindsight that you look back and go, wow, like I was only in first gear.
So you moved from an SUV to a V8 supercar on the track.
Yeah, and it makes me think, like, is there still a Learjet that's
Formula One.
Exactly. Yeah, there's the Formula One car that we can step into next.
Yeah.
So I'm excited to see where the takes us.
You know, that's going to make our question for our next thingy, don't you?
Yeah, and look, and also fascinating on that, like about Sam. Sam went out into his own business, and his growth that he had going out on his own was like crazy.
Yeah.
So, and I don't think he could have done that unless he'd walked out of our business either.
Yeah.
So it worked out for both of us.
Yeah.
And we see it as a blessing.
When you say that, I'm imagining this tree with the branch separating going and making flowers on each end.
Yeah.
It's like blossoming from,
Yeah, and there's an interesting thing, I don't know who said this, but it's like you've got to be the right person in the right opportunity. And if you're like a 9 out of 10, but you're in a 3 out of 10 opportunity for you, then your potential is always going to be limited.
Yeah.
And just in the context that I was in, like I see myself as a 9 out of 10 person, but it was like a 3 out of 10 opportunity because of the environment. And now it's a 9 out of 10 opportunity. And like it was the same thing for him going into his own, what he's now created. So it's just like, if it's either you, how you're showing up, or it's the opportunity that you're showing up in that's going to be.
Because there's always environment.
Correct.
Yeah.
Exactly.
Well, thank you very much.
Thanks, Ian.
It was fascinating.
Yeah, pleasure.
Okay.